bank statement loans. That's actually one that I do think, for a lot of people in this room, self-employed individuals, that this particular product is one that you could take advantage of. Now, a bank statement loan works for primary residence, it works for a second home, and it works for investment properties. Now, a good candidate for a bank statement loan is going to be obviously a self-employed individual, someone that has good cash flow coming through their bank statements, because with the bank statement loan, we're going to look at the last 12 to 24 months worth of bank statements, and we're going to analyze the cash flow through those bank statements and use that as your qualifying income. There is a DTI component to this program. Typically, it's in line with that 45%. If you're using it as a primary residence loan, it's going to be 10% down. If you're using it for a second home or even an investment property, it's going to be 20% down. If you're using it as a second home, there's no prepayment penalty. So that would be one of the advantages with using this program over maybe a DSCR. The interest rates on both the asset qualifier and the bank statement loan are going to be pretty much in line with the DSCR. There's not any significant advantage one way or the other. Really, it's going to be about the prepayment penalty on the bank statement loan. Disadvantages, again, this is a non-QM loan. Most non-QM loans are originated through brokers and wholesale channels, and you're going to have higher fees as compared to your QM product, your Fannie Mae product. Less competency among loan officers about the nuances of this loan product. Understanding how to, literally you got to go through 12 months worth of bank statements. Each one's got 5 pages. It is an arduous process, but what I'll say is the technologies that are, the OCR type technologies, the things where we can just upload those bank statements and it tells us what we're looking for is here. So I think the actual processing of these loans is going to be quite a bit easier for both sides. Disadvantages on a bank statement loan, lenders can hide yield spread premium. We're going to get that in a minute. That's one thing that I really want to touch on today is how to identify yield spread premium, how to shop your lenders. But with these non-QM products, again, there is the ability for lenders to conceal the yield spread premium, which in Fisher-Price terms is the money they're making. Right? There's front-end money and there's back-end money. The front-end money is what you're going to see on your closing statement. It's going to be the points and fees that you pay. The yield spread premium is what you don't see that is being compensated on the back end. This is something that is, that 2004, 2008 experience that is making its way back that I'm not a fan of. I'm not. Now, you got to understand how to shop that. And what does that mean? That means that there's an opportunity for that originator to sell you a higher interest rate than what you really qualify for. Now, in most channels, when a loan is originated and there's yield spread premium, we call that rebate. You might have heard of that on a loan, where you get borrower rebate to help with your closing cost, things like that. But this return of concealing yield spread premium is allowing them not to pass on that rebate, but keep it for themselves as a form of compensation. And that's going to be more prevalent in your non-QM type loans. A lot of the things that y'all are going to be probably, if you're going to scale, you're going to be getting some type of non-QM loan, most likely.